qualitative characteristics. So that's going to be starting on page 10 in your textbook. And these are very important because these are how we make, these are the assumptions and the characteristics of the reasoning behind when we make our decisions on doing different kind of adjustments, different kind of entry. So we're going to look at these, the assumptions, the principles, and constraints. Qualitative characteristics. All right. The first one. And accounting being as it is, it needs to be useful information. So that's something we need to bear in mind. If it's a report or something that we don't need or nobody needs, then we're not going to do it. We look at usefulness. We look at it. If our reports, remember we did our statements. We wanted to be sure that they can be used by management. Is it relevant? Is the information that we're given, that we're accumulating, that we're showing on our statements, is it relevant information? Is it something that management needs to know? If not, we can shorten that. We want to present just what they need to know in order to do what? What's accounting all about? Making the decisions, right? Decision making, right? Okay, so got to be useful, understandable, relevant, and what's reliable? Key factor. Can they trust it? Boy, there's a lot of stuff on the news right now about these in there. What's going on with all these companies and all this? Okay. Reliability. Is it the truth? And is it neutral? Unbiased? Is it not slanted toward, which a lot of these that are coming up in the news now, the reports are slanted, just like way back with the Enron thing. They were presenting what they wanted it to look like and not a true picture. So neutrality. Comparability. This is why we use our accounting standards so that we can look at one person's balance sheet or one kind of company's balance sheet, compare it to another company in the same business, and compare the two to see if we're trying to make a decision on buying stock or something. We can look at it and see how they're doing. It's got to be complete, and it's got to be reveal all aspects of what needs to be revealed. So, all right, usefulness. And what's our key word here? Decision. Remember, we're in accounting to make decisions. When we start doing some of these problems on this chapter, you're going to have to make some decisions. And you're going to base it, you're going to look at decisions that were made and say, well, are they complying with the guidelines? You know, is it useful? All right. Understandable, clear, and it's got to be clear to the point of who's your audience? Who's going to be reading this? If they don't have a clue about business and economics or accounting, you're going to need to be very specific in how you present it so they can understand it. Relevant, and this is important. In order for a decision to be made in a timely manner, then you're going to have the information before we make the decision, right? So timeliness of the information, and it should have both tell them what could happen and then have a feedback value where we can go look at it and see and come back to the report to see if it actually fulfills our goal. And reliable, dependable, it's verifiable on all of our transactions. What did we have before we wrote it in the journal? What's the audit trail consist of? What do you have to have in your hand on your practice set? What did you have to look at to make an entry? Receipts, something to back it up, right? So it's got to be verifiable. So checks, invoices, contracts, any kind of information that we're going to keep to verify what we're writing in our book. You can't just go in there and start writing stuff. We receipt. All right? Neutrality, again, helpful to all, doesn't favor any one group. And be able to be compared from previous statements of the same company or two other companies in the same business. All right. Comparability, consistency, and consistency means, remember, and you hadn't had it yet because we only used one method of depreciation, right? We just use straight line. So if we continue to use just straight line, then we could be comparable. However, if a new accountant came in and said, oh no, we're going to learn different methods of doing depreciation in this class, you're going to learn that there's other methods, and they change it to some of the years digits or one of the other methods, then if you look back and you're looking at depreciation expense when you were using one method, and then you go and you're using a different method, it's not going to be comparable. It's going to look, it's going to be skew or change the look of that financial statement where it's not comparable to previous ones. Right. Okay. That's objective 4. Objective 5 is, here we go, and this is what you saw at the first place, right? Economic entity. You learned that one way back about the service companies, right? Not the merchandising company. Has to be separate. What does that mean? Y'all remember what that means? It's got to be a separate economic entity. What does that mean? Does that mean keep your personal account separate from the business account? Exactly. Can't be commingled with personal. So the business must be considered separate. Separate books, separate money. Going concern. We're assuming, when we're doing our accounting and everything, that we're going to keep going, right? We're assuming it's going to continue next year and the next year, barring anything unusual happening. But have to, we can't change from dollars to euros or some other method, so we want to stick with our monetary unit, right, in order to be consistent. And the periodic periodicity. Yeah, that word. Monthly. That we're going to measure our income using accounting periods, right? And what we were doing is what we were doing monthly. Now some companies do it monthly, but then they'll have a big end of the year annual statement, that they do, that they release to the public. All right. Separate entity means, this is just a review, keeping that money separate. Company's going to keep going concern. We're going to use a monetary unit that keeping records in terms of money that is stable. We're going to record or report at certain time periods our income so that we can continually through the year be doing comparisons and make decisions. All right, now, here's our general principles. It doesn't. You like freckles. It just like it keeps going up. And I know it's often up. I don't know how to do that. That's because you got to cut it on. I would fall asleep in that thing. to do with things that we buy. We use what we actually pay for it. Revenue recognition. Remember, we recognize the revenue when we earn it, not necessarily when we're paid. Right? Matching expenses to the revenue in the period in which it was earned. We're going to really dig in, and as you keep going into deeper and deeper into accounting, you find that there's all kinds of things we start looking for. We just use the general ones, in our previous experience. But we start looking for everything that could possibly be counted as an expense that was expensed or earned in that period. So people know when they file the taxes. Yes, exactly. Only taxes are actually based on cash basis. So in taxes, you have to have paid it. When you're doing your tax return, it has to have been paid during that year. In our matching, or when we do our in accounting, we accrue things, meaning even though we hadn't paid it out in cash yet, we still record it. But on your tax basis, not so. It has to have been paid or received. Like on your W-2, even though you work, well, that's not a good thing because they try to do the W-2 through the end of the year, but
that's when people pay for gas and they keep the receipt and use that.
Yeah, the receipt has to match the year that you're in. Exactly. And full disclosure, meaning we're going to disclose everything and not hide things that could change or not present ours. So historical cost, that's what we paid for it at the time that it's acquired. Recognizing revenue, determining which period to recognize it, when the work was done. Right? So when we completed the job, that's when we recognize the revenue. Not necessarily when we get the money for it. Only in the period which it has been earned, and only if it has been realized. In other words, we've completed it. Matching, we're going to try to match all costs and revenue in the period that it actually occurred. Full disclosure, we're going to disclose everything. We're going to tell them how we figure the depreciation. We're going to tell them how we determined if we had accounts receivable and we had to, we didn't think it was going to all be paid. How did you determine your allowance for doubtful accounts? We're going to disclose all that information. Okay. And attachments to the statement, footnotes, there's usually footnotes that are added to your statement. So we haven't done that yet, but to explain how you came about, how you did your depreciation. Okay. Okay. Modifying constraints. How do we make our decisions? Materiality, the cost-benefit test, conservatism, industry practice. So, materiality, meaning. How do we do this? What's that? Do we want to do that?
A first aid kit or B first aid kit?
No, we do. Is it significant? Is what we're looking at significant material, big enough to report, big enough to disclose? The cost-benefit test on whether or not to do something. All right, let's say we have a business and we're depreciating stuff, or what are we going to depreciate? Are we going to depreciate every single thing that we buy? Trash cans that cost $5. So, along with materiality, did it cost enough to be mentioned or